Hello everyone, how's it going? Welcome to my channel where we talk about the most interesting titles in the market. In the world of investing, people are often asking themselves, where is the next big thing? And how to accurately seize the opportunity before they take off, and how to profit from a safe, predictable income stream. It is precisely to answer those needs that the title of SCHD has been created. It is an ETF that correlates and also includes some of the world's most famous and successful companies, and distributes dividends from the stocks incorporated within it. To a large extent, the Schwab US Dividend Equity ETF chooses the safest and the most stable industries in our economy to invest for the long-term holding. Perhaps another reason why SCHD has attracted so much attention from the market participants is its price action since the inception, as well as the dividend track record. Over the past 5 years, despite strong economic headwinds, the Schwab ETF managed to increase its share price by almost 50%, which is, in that regard, very impressive and has beaten many of the more riskier counterparties on the Nasdaq. If we go back as far as 2011, when it first began trading, SCHD increased by more than 183% since that humble beginning, which really shows how far the stock has risen. So, before the video begins today, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the past few days, SCHD has been hovering around the $76 mark, showing a 6% increase from a month ago and a 7% uptick from 6 months ago. Notably, it is up by approximately 17% from its low point on October 27th, rebounding from around $67 and maintaining that level ever since. Zooming out to the bigger picture, SCHD has been moving sideways throughout the year, closing just 0.34% higher than its position at the start of 2023. And despite this, the market seems intrigued by this title, yet lacks the need or any reason to propel it ever higher. This real and yet cautious optimism is very noteworthy in a year that has been marked by persistent downward pressure on equity prices and hints of an impending recession. Considering SCHD's focus on dividend stocks, it remains a very steady choice even amid historically high inflation and an already attractive risk-free yield of capital. With a respectable yield of around 4% and a track record that keeps increasing the dividend over time, SCHD stands out, that's for sure. However, when compared to other safer investment options, its appeal extends beyond just the yield. Looking at the big picture, SCHD's popularity among both institutional and retail traders adds an extra layer of interest. This widespread appeal could potentially spark compelling upward movements in its price, so keep an eye on SCHD as it continues to navigate those dynamic market conditions. With that being said, let's have a look at the technicals. The trading volume of Schwab US Dividend Equity ETF has been around 1.7 million shares compared to the average of 4.1 million shares. Over the previous 52 weeks period, the price fluctuated between $66.67 and $78.73. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there is enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could also mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, for breakthrough, the current volume would be significantly higher than the average volume. The assets under management of Schwab US Dividend Equity is currently around $52 billion. As we compare the current price to the historical price fluctuations, the stock is 7% higher than the 1-month low, 14% higher than the 3-month low, and 14% higher than the 52 weeks low. On the options market, which gives us a hint on the market sentiment about where the stock might go next, the implied volatility is 11% compared to the historical volatility of 12%. The put-call volume ratio is currently at around 41%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 276 contracts within a day, compared to the 30-day average volume of 2.4 thousands. Regarding the open interest, the most recent volume of open interest is 57,000 contracts versus the 30-day average of 61,000 contracts. As for the shareholder structure, institutional holders currently own about 40% of the outstanding shares. The biggest shareholders include Charles Schwab, the Bank of America, and Morgan Stanley. Typically, it's always encouraging to see institutional presence when holding a stock long-term, because it offers a layer of stability and a token of reliability in the long to medium term. It means that the market is confident that it will deliver value in the long term, which is always an important factor to consider for the investors. I personally would consider the minimum threshold to be around 30% for institutional ownership if I want to own something for the long term, which is 12 months and above. The current short interest is around 874,000 contracts of the total float, 40% of which come from the dark pools. Typically, if the short interest is above 15% of the total volume, and this is very far below it, and a significant portion of the shorts come from the dark pools, this may suggest institutional presence for a concerted shorting operation, and that there would be a potential for a short squeeze. This is not the case for SCHD. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, regarding SCHD, I would recommend to build up a position slowly over time, because as the interest rates come down, there may be a renewed sense that things will be on the uptrend, and more capital may come back on the equity side in order to earn a yield. At the same time, caution is highly advised because a market price of SCHD is currently at a historically high level. Regardless of the market volatility, though, SCHD may be a decent stabilizing element for any portfolio with a long-term perspective. I would recommend to commit overall between 10 to 15% of your portfolio on SCHD and to split the allocation in batches of 20% at a time over the next 3 to 6 months so that you may purchase more in case it retraces.